And here's Tom.
Yeah, hi, thanks, Peter and Rita. Here's Tom Williams here, speaking to you from Worthing, which is a little resort town on the south coast of England. And I'm glad to tell you that the weather's gorgeous at the moment, so we're all happy there. Right now, what have we got up on the screen here? This is a weekly chart of the the mini S&P 500. Now, it's surprising really, because it doesn't matter what sort of feeling you have about the market. It is, when you look at a weekly chart, in an obvious uptrend. And we got a surge. We got a surge here of higher prices on so-called news. Well, we know it's not the news itself that alters the prices. It's the professional money using the news to mark prices up or down, or even whipsaw the market to better their trading positions. I mean, when you think about it, is that how on earth can some news like payroll or whatever they call them how can that alter the movement of the S&P 500, which is where the whole equity of the market lies? It certainly wouldn't have any impact, but you know, they like to tell you it does. They like to tell you that they're there to help you, which is a big laugh. As far as I'm concerned, you'll never find them out there helping you at all. As a matter of fact, they'll do the opposite if it's possible. And they'll say, yeah, but we give you all the news events. But that's helping them, not you, because on the news, that's why they specifically tell you, oh, it's at 1:30 or it's at 1 o'clock Tuesday. They give you all this careful information as if they're concerned about your well-being. That's a big joke, because what they tell you, so you listen, right, to the so-called news, and on that they whipsaw the market to benefit their own accounts. And that's what they do. They certainly don't tell you the news to help you at all, although they try to give you that impression. Now, this is a weekly chart here, look. And what's interesting is, I noticed, you go way back to the lower part here, where it started, look here. Now, when you hear us talk about the simple trending system that we follow, or recommend you follow, because once you're in a position, especially if it's a good position, a bullish position, you can very, very easily get shaken out of a trade. No end of people who rang me up and say, oh yeah, I got in on that low bit, but I sold out at 10 o'clock or something, and if I'd have stayed in, I'd have made a lot more money. And that's a very, very common thing. Now, the trending system will help to tell you, keep you in a trade a lot longer than you normally would do. And the trending system is based on the fact is that once professional money are into a move, into a bullish move, it's their responsibility and to their benefit to make sure the trend or the up movements continue. So what that means is that at the end of each day, the close of the bar, right, is always higher than the close of the previous bar, and that keeps the trend going. Because a big enemy to people who've got large sums of money in this market, this market up, right? The worst thing can happen to them is other outsiders, other big traders come in and start selling into their move, and they'll lose control, and that's the main thing we have to do. Now, the rule of the trending system, I call it a simple trending system, is that the close has to be higher than the close of the previous bar, right? You allow for one down bar and you ignore level bars. It's as simple as that. All the time that's going on, you're trending up. And that's a great help to you if you're in a position, especially if you're like a fund manager or you're looking for a long-term move rather than scalping, right? And here we are at the bottom, look. Okay, so there's a signal there, look. Okay, this is a weekly chart, bottom reversal, right, which is a sign of strength. Now, blue bar, up, blue bar, up, blue bar, up. Allow for one red down bar, and that red down bar should be on lowish volume, because that means bullish volumes, expanding volume on up bars while decreasing on down bars. So there's an example of decreasing on down bars. Okay, so there's the volume there. It's quite low, look. Right, so we've seen that. Up bar, down bar. Volume's low, look. So there's no selling pressure. Up, 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 up. Now there's a yellow box there, and the reason why there's no signal is because the next bar's up. Up, up, up. Allow for one down bar, and there's your reduced volume. Right, this is a weekly chart. So you could have been in this move all this time. Up, up, up. Allow for one down bar. There it is. Now, what's interesting there is that we have a principle there that's one of the strongest signs of strength we have. First of all, we have a red arrow here. No demand. Now, just because the market went up after this doesn't mean to say it's wrong. What it's telling you is at that moment, right, professional money backed off. Right? However, the next bar's down where they tested it. And there's the volume, right? And whenever you see a test, that's a down bar, narrow spread, close near the high, and volume not high, right, as the market's moving up. Immediately after a red arrow, look, that's what they're testing, this. It's a very, very strong sign of strength. Right, you see it a lot. There may not be a signal on it, but there will be a signal on some of the, on different time frames. But that's a test. That is a test in a rising market. Right, so, right, we've allowed for one down bar, up, allow for one down bar, up, down, up, up. So it's still going up, look. Although that bar there, the last one, because it's not finished yet, has got a yellow box up there and it says no demand. But it's not finished, obviously. Well, yeah, exactly. But the significant thing is here is how the trending system works. Oh, people don't believe it when you tell them, but there it is in front of you, look. Allow for one down bar, up, and one down bar, up, and you ignore level bars. We don't have a level bar, which will be in black. But as we go up there, it's a weekly chart. And that's a hand holder, because it's very, very easy to sell out too soon. But this strategy will add to your trading skill. So this is more or less longer term, especially if you're trading a stock or stocks. Now, is there any questions about this particular chart, a weekly chart of the mini S&P 500 showing the trending system? And we're actually into new high ground at the moment. Anything?
Edmund, one from Leonard, who's saying, which time frame does your trending system work on? Well, it's any time frame you can follow the trending system. And Edmund, for the simple trending system, if there are consecutive down bars, do we exit the position immediately, or do we wait for further confirmation of price action being weak?
Well, as far as different time frames are concerned, it works on any time frame. I mean, I've had people say to me once, impossible, you know, you're talking a load of rubbish. How can it work on any time frame? You know, but if you check it out, it does. Because you're looking at the same overall picture of the condition of the market at that moment. That's why it works. And as far as exiting, right, you will see eventually weakness appearing. It'll appear on very high volume and up bar, and even that varies slightly. If the spread is narrow, if it's in fresh high ground, and the volume is very high, that's a serious sign of weakness, and you'd expect that to be a market top. So we don't use any mathematical formulas. So there's no such thing as when do we close it, how many bars and all this, because we don't ask ourselves that. You read the chart as it's unfolding. And if you get two sudden red down bars, you can bet your bottom dollar there's weakness right behind you anyway. There'd be weakness. And then if you're in an uptrend, don't forget, expect momentum to take over as well. So you may get two red down bars, but because of the upward momentum in the market, it could probably still go up a few bars, probably on no demand. So you have to read it as it's unfolding in front of you. But these time frames are interesting because even the programmers are clever guys. I've had them say to me, oh, well, that's impossible. You can't expect signals and everything to work on every bar, right? They may not work on every bar, but each bar is a principle, a picture, should we say, of the same scene. And that's what's going on. I describe it, you know, you're in a hospital and you're a doctor. The doctor goes up, sees a patient, got cholera or something, right? So you give the treatment and whatever. Now, it doesn't matter how often you check up on that patient. Your cholera is not going to be cured until it runs its course, right? And then you'll be able to see the course ending with whatever doctors look at. And so the market's the same way, and you're dealing with human beings. That's why all this tends to work. Okay?
When it came through, that's all. Malcolm asks, would you make an exception for a single high volume widespread bar, i.e. what Gavin calls a gotcha bar? I'm not sure when that...
Well, when Gavin talks about a gotcha bar, see, what we're talking about when he says that is that they say you get signs of weakness appearing, right, which you will do. And then if it's confirmed by a widespread down, closing low, what they do, the professional players on the floor, once they've got over their selling bout, whatever they're doing, they want to lock as many traders in or out of the trade. And if you think about it, you can see how that could cause you losses, because you can't cover your position, you can't get in, you can't get out, because there's huge widespread down. And that's why Gavin calls it as a gotcha bar. It's one of his terms, not mine, but that's what he's on about. And you'll see, if you ever see the so-called gotcha bar, as the market falls after you've seen a few red arrows, then that's really confirming the weakness. Does that make sense? Well, the rule will always follow the correct procedure. What you mean, if you're watching the market trending up and suddenly...
It looks good, the trending system is being followed, and then suddenly you see, in this case, for example, a high, it's probably a bad example actually. Supposing you saw end of rising market,
yeah, well then...
you still actually might decide it's time to get out.
Oh yes, well you would, because you're reading the balance of supply and demand. And you know, when you see end of a rising market, that's going to be more or less 100% correct. But that is, in fact, it's the end of a rising market. And you see that, but if it's marked up or gapped up into fresh high ground, and the volume is very high, right, and probably on good news, right? The reason why it's end of a rising market, because the professional money, every time a buy order comes in, as they rush in to buy on this gapped up, never-ending bull market, right? Every time a buy order comes in, it's satisfied more or less immediately, and this caps the top end of the market, causing a narrow spread. And it's inevitably 100% correct. So, but you see, what we're doing, you're trying to follow the, well, you are not trying, following the trend of the market. But one of the most difficult things is, as you probably know, is that once you're on a good trade, to stay in it and try to squeeze as much as you can out of the move. Not selling prematurely, which is so very easy to do. You know, you made a few $100 or something and you think, oh, I'm going to take this. But if that trending system is telling you the market's bullish, it would pay you to stay in and get as much as you can out of the move. But there's so many different ways you can trade these markets. That's why we can't possibly tell you exactly what to do, and I certainly wouldn't like to attempt it. There's no end of ways you can make money from these markets.
Carlos is asking, Tom, do you encourage scaling out of a position?
Well, scaling out or scaling in is wonderful if your skill as a trader can do that. I personally don't do that, although there's nothing wrong with it at all. And there are many professional traders successfully that pyramid, they call it pyramiding, adding or taking away from the trade. But it's all your style. Nothing's right and nothing's wrong. As long as you can read the market and your skill as a trader is kicking in. That's what it's all about. It's a good idea to scale out. But there are times when you can scale in pyramid. And this is one of the obvious ones here. Look, whenever you've seen an up move, Look, substantial up move. You get a red arrow, right? And the very, very next bar is tested, look. That's a very certain sign you can get higher prices. The market may fool you by coming off slightly, look, but you will be expecting higher prices.
Peter is asking, can the last bar, no demand, be the first sign of imminent market reversal?
Well, no, in this case, we're looking at a weekly chart. So the no demand that's apparent on that bar at the moment certainly you wouldn't be able to know until the market closes Friday. You've got to be careful. But to answer that, you have to go to a lower time frame, which I'm sure we could do. Yeah. Now, this is a daily chart, look. Now, funny enough, there's a red arrow, look. And now there's no signal on it, but look, there's a test. Down bar, narrow spread, look. Don't forget the spread, volume spread. It's actually activity, and on that activity, what actually happened. So it's down, narrow spread, close to the middle. Volume is low. That's a very powerful sign of strength. And that's why it's gone up, look. But here, daily chart, there's quite a long way to go yet before the end of the session. And that's why it's marked with that box, because it's looking at it. It is at the moment going up on no demand, but of course that's not probably the full story. Now, anybody out there doesn't fully understand the principles of supply and demand. I see there's one or two newcomers. Because if you can get your head around clearly exactly what you're looking at, then it stands to reason that you'll understand the chart and the market far, far better. But remember, the market is devious. It's cunning. It's there to trap you. It's not there to help you. There's nobody in this stock market that's out there to help you. Why? Because they're to help themselves. They don't want to help you. And they will do all sorts of things against your interest if they can, because that's how they make money.
Okay, question here. On the daily SPY, there were several down bars the week of April 15. Could Tom comment on that? Yeah?
What they want me to talk about these charts. Now, keep in mind that professional money will expect the market to become vulnerable to the herd panicking somewhat, right? And that won't happen on 1 or even 2 bars. You need a down move of some sort behind you. Like even here, 1, 2, 3, 4, 5 bars, look. Right, and then when the lower bars appear, right, you'll see the spread has narrowed, has got narrower. If you're lucky, there's a nice signal on it. Okay. Now, you won't expect professional money to buy into these markets unless there's a fall of some sort, because the market is not a good bet at that moment, is it? It needs to fall more. Unless it's a shakeout, which is a shakeout on bad news. You can practically always tell a shakeout. Some sort of bad news appears, serious bad news. They ram it down very, very quickly, only to close on the high very quickly. And you've got a bullish move behind you. That's a shakeout. You see that quite often, very often, right? So here, there probably was a bit of buying, look, on there. The volume's increased, but it's all very well. But normally, a wide spread down, closing on the low, as it rushes towards former areas of support, is not bullish, it's bearish. In other words, well, bearish enough to, you'd expect lower prices on that increasing volume. And there was a bit of buying on there. The next bar went up, look. But it's certainly no momentum on the upside there, is it? Because the volume's too low. But here you see, now here where we've got these signals, there's a signal there for simple reason is that the spread has narrowed. Yeah. And that's why the automatic signals tells you that strength is coming in. That means that professional money must have stepped into the market because the spread has narrowed. If you look at that spread, it's down into fresh low ground. And in that case, there's not a lot of selling pressure. And this next bar's up on that, and that's why there's another signal appeared. And it's called a reversal, which is a sign of strength as far as we're concerned. Right? So you have to get a feel for it. But the main thing is that you can't expect professional money to be interested in moving into the market with thousands of contracts unless the market has fallen somewhat. And that creates pressure on what we call weak holders. A weak holder is a trader that if he sold right now, he would be losing money. And as the herd thinks, we all think the same or very similar, that as these markets fall like this, right, the professional money is doing that deliberately to try to shake you out, right, which it does in most cases. But a weak holder, somebody, if they sold right there, they'd be losing money. And weak holders don't like that. And very often they say, right, okay, I'll hang on, especially if this next bar's up like that. Say, oh, look, it might be going back up. And they hang on, and yet when it comes to this bar here, they say, oh, I'm not going to stay in here. And we're talking about group behavior, which causes all this. It's the way the herd behaves. And that's what causes the strength here. Does that answer that question?
Could you put up, sorry, the ES weekly again? 300 bars pick starting on. I'll read this. I'll read this out in a minute. All right, we've got a question from Colin. I have a trend channel on the ES weekly, 300 bars starting on the 6th of March 09. Do you want to put that up, Pete? Peter's going to try and set up the chart. That's Tom's just pointing out the support and supply areas. It's Yeah, trends. Trend channel. Great. Right. Once you've done that, right. There is also a high on the 12th of October 07 at 1586. This level is intersecting with the 3/4 line on the trend channel now. But the thing is, no, but well, that it was just a statement. So on the 12th of October there was a high, Peter, 07. And yes, GR, we will have a newsletter this weekend. Oh, right, hang on. 12th of October 07 at 1586.75 there is a high. This level is intersecting with the 3/4 line on the trend channel now. And what's your question, Colin? And put your, so that Tom's asking for the trend club. So what's, is there any significance in that? Maybe that's the question. Oh, right. No.
Maybe it's too far in the past.
Well, it's certainly got, it's running into some resistance because it's hitting the top trend line, look. But there's no trend clusters as such. If there was a trend cluster up there, right over the price now, I would say that's not going up very far at the moment. Because when these lines cross over and the data eventually reaches them, then that's definitely a resistance area. Now, why these trend lines work so well, I've never figured it out. I've never thought about it too much, to be quite honest. But I'm sure somebody out there can explain the trend line. It seems to be what traders do as a group. That's what seems to make them work. But right now, it's rushing towards that top trend line, which will automatically be some resistance area. And of course, it's Friday today, and they love that if they can distort the picture over the weekend so the papers, magazines, TV programs can start putting their own judgment on it, which inevitably most of it will be wrong. Because keep in mind, you know more about the market than they do. Just because they're writing articles in papers and things doesn't mean to say they know more than you do. But if that finishes the day on no demand, as it hits that top trend line, you'd expect obviously some hesitation in the market next week. And if it was still bullish, you'd expect a test. Now, if we talk about bullish or bearish market here. Now, you all know, you've heard me talking about the KG chart. Now, what the KG chart shows you is if the market volume is bullish or bearish. And it's been bullish for ages. Which if you listen to it or things I've said or written in the newsletter, that will confirm it. But the market actually is bullish volume all the way up here. And you'd be very ill-advised to not observe that? Bullish volumes expanding volume on up bars while decreasing on down bars. Bearish volumes increasing volume on down bars while decreasing on up bars. And that is how the market works, and that's why you'd be ill-advised to ignore them as an overall guide of where this market's going. And that's why I like to look at the daily chart, because the KG chart at the moment only works on a daily chart. Okay.
Okay. David says the SPY ETF is bumping into a trend cluster on the daily chart. And Mark would like us to look at the 5-minute of the ES. Shall we have a look at that now? Flick across. And GR, yes, we are going to have a newsletter this weekend. We are Sunday, we can do it, yeah. And we were glad to have Peter last week, but you're better looking, Rita. Did you hear that, Pete? People don't know what I look like. GR, thank you, GR. Right, okay, the 5-minute for Mark.
I laughed at that. Peter looked up and said, "Who's that? Who said that?" Anyway, yeah, we all like Rita. Peter's a very clever guy, but somehow we all like Rita. Okay, now this is a 5-minute chart of the S&P 500. Okay. So, there's the gap up look on the news. Right, trundle sideways. It's down bars there, look. Now, there's a sign of weakness right there. Up bar, narrow spread. This one is on no demand, though. Okay, so you'd expect it to, at least at the best, drift sideways. Right, so it came off a little bit, look. And you can read this as you go along. Right. That looks like a little bit of a shakeout there. Up, 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 up. Now there's a red arrow, look. Now that's interesting. There's a sign of weakness. That's a sign of weakness. But the next bar, look, is a black bar. That means that if that was weakness there, which it probably is, it's genuine weakness of some sort, look, no demand, but didn't affect the market much because the next bar's level, look, a black bar. Now, if you look at the trending system, right, blue bar up, 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 allow for one down bar, ignore level bars, up, 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 ignore level bars, down. So that means this one's probably going up. I mean, in that, it looks quite confused, that 5-minute chart, and yet trending system still works, look, which I think is very interesting. Now, what we need to see is serious sign of weakness here if we want this market to stop going up on this trend line, top trend line that we saw. And there's a little bit of no demand there, look. It's a yellow box, and it produces a yellow box if the next bar doesn't confirm the sign of weakness. In other words, fall. It hasn't, it's supported, look, level bar. I would say this market's going to be held up for the rest of the day and probably try to move up through that top trend line and become oversold.
Right. There's nothing to say apart from a few comments about pictures of me. So, no, I haven't, but obviously people can find out somehow. Even the dog. Any other questions? Does anybody have a chart or anything that they'd like Tom to comment upon? Otherwise, the black bar with the top tail.
Yeah, that looks like the top tail. That's why it's come off. These 1, 2 bars.
Yes, Tom says that's why it's come off a bit.
Well, at least 1 bar.
1 bar anyway. Yeah.
Current bar is going up. Right, but is it going up on no demand?
So you'd have to wait to see if this current bar is going up on no demand. Can Tom take a look at gold, please? Yeah? The daily chart of gold.
That's 20 bars or more.
20.
This is the top trend on the bottom.
So look, I think it's probably
Oh, it's bottom.
it's drop through it. Is that still there?
And yes, Park, there will be a newsletter this weekend. Back to normal now. I haven't actually caught up on my sleep from my week away, which was very trying, but yeah. Tom, this gold.
Well, gold, right. I don't normally bother too much with this gold market because there are so many amateurs in there. You don't know whether you're coming or going sometimes. But it's still run professional money, still works the same way. But as this plummeted down here, we've become very over sold. So there will be a professional people who will say, right, okay, I think we can buy into this and make a little bit of money on some, at least a bouncing effect. What's this line here, Peter? This.
Just whether you click the cursor. It's a cursor click.
Oh, is it? Anyway, the market, when it becomes oversold as bad as that and marked down heavily, probably on some sort of news, right? And it looks like a test there, look. And the volume is low. And that actually is a test, look. And that's a bullish sign at the moment there. And that's why you've got these higher prices, because of that black bar there, look. It's been marked down. First of all, there's a high volume here, look, where professional money or somebody stepped in and bought here, right? But you'd expect that to be tested at some time. Now, because we don't use formulas of any sort at all, we don't know when that test is going to happen. But when it does happen, you should recognize it. And there it is, lo and behold. It's a black bar. It's been marked down quite heavily. Or even that's a test there, look. So you've got two tests. You've got that red bar there.
Test after shakeout.
Yeah. So when they say test after shakeout, I mean, this is the shakeout here, this rapid move down. And then a narrow spread down, closing in middle or high, and the volume is clearly low. That is a test. And there's another one, the very next bar, look, they've double tested it. Now that could be a strategy to mislead as many people as possible, but the end result is it's a test, and that's what's driving this up. And every time you get a red signal appear, look, right, it's tested next bar. That's bullish, and this is it's floating up at the moment. You've hit no demand here. This trend line here is the bottom trend line. That will act as resistance to higher prices if the data gets near that or up there. So keep that in mind. But certainly not the time that you rush in and buy this. If you miss these opportunities here, look, with the stopping volume and the testing, if you miss that, then that's lack of concentration, lack of knowledge, lack of understanding what you're looking at. And that's what marks the professionals from the amateurs, if you spot that. But that is a clear principle, look. There's clearly stopping volume, look. You know, nobody can argue against that. It's been marked down quite heavily, so it's oversold, right? And then they test it. That's definitely a test, look. And here's another one. So the market's there to fool you, trap you. So even if you saw that test and you'd have bought it, you'd be quite alarmed and the very next bar it's marked down here. But you have to believe the principle that that is a test and that is stopping volume. So you have to believe the principle and you would stay in the trade. And there's another red arrow, another test, and it's drifting up at the moment, really on no demand. But this market's very, very liable.
Sorry, Tom, do you want another drink?
Yes.
Tea?
Coffee. Sherry, it is. That's Rita. She also makes us tea and coffee. But she's very good at it. So I thank her for that. Now, it's definitely going up a little bit on no demand. We have a built-in sign of weakness appear up here, look. Potentially no demand. It's rounding over. But if you see a test now and that surge up to that trend line will act as a strong resistance. But you do have some buying here. Keep that in mind. And that potentially they will want to unload holdings bought here if they figure the price is coming off. And that will appear on not just no demand. It'll be an up bar, narrow spread, volume very high. And then you'd expect the price to come lower. But that bottom trend line there will act as heavy resistance. And they love to do that Friday. They'll mark it up. So all the TV and the papers, newspaper, gold is rallying again. And that will encourage people to go in a long position when the market could easily be weak. Corn. Is that corn?
I'm trying to find the right. Oh, here we go. There's a request there from Eleni Corn and Weeks she's after.
Right. You've got to be very, very careful with these commodities. Very. I mean, that bar there, look, although admittedly, right, on the low here, it's been gapped down, which is not a good sign. When they gap it down, they get huge gaps down. But there's no follow through with the weakness. Here we've got narrow spread.
Those files
no supply or test. Right. There's our red bar, red signal. And the next bar is tested, look. Red down bar, narrow spread, closed middle or high. Volume is low. That means it's going to go up. So you do have principles here at the bottom here. Was gapped up. There is supply here on this bar, seen by the very high volume, and that's why they've attempted here to test the market. It's fallen, look. It closes in the middle, and the volume is low, and that's why it's gone up there. Markets move on supply and demand. And there's an example there, practically on all those bars. Perhaps we should write a newsletter on this, and then if people have a text, a chart with text, then it gives you time to study it and absorb it over a few weeks, should we say.
That's lumber.
Lumber. Well, lumber's definitely trading down, look. That's a sign of weakness, up thrust. There could easily be stopping volume here, look. But if that's stopping volume, this is going to have to probably go up 1 or 2 bars like this, and then you would not be interested unless you saw that fall back down to this area here where this high volume is, and low volume appears. That means that the selling that was here on this bar, right, the supply that was there, if it goes up a few bars and falls back down that level, right, especially if the spread is narrow and so on, then that's bullish. But right now, you would do nothing unless you'd like to gamble. You might possibly squeeze a little bit out of it if it goes up a few bars. But it's commodity. You've got to be very, very careful. All right. Thank you, Rita.
That's interesting. Wait. It's a computer game, isn't it?
You know, that's a test, isn't it, at the end? That looks like they're trying to get higher prices. Whenever you see these red down bars like this, they're gunning for higher prices. Now, what I just told you before, right, there's the stopping volume in lumber, okay? You can clearly see that, can't you? Right, bit of no demand, that's all right, because you'd expect, especially commodities, that volume to be tested, right, falls off, black bar, not going anywhere at the moment. Now, is it coming down for test, this high volume here? Right, say we draw a line across there. I think, is that right? Yeah. Now, so there it is, falls. Now, look at that low volume compared to this volume. That's what we're looking at. That means that the supply that was there, which they must have absorbed and bought everything, because when the market fell back down to that level, look, and above all is a narrow spread, and the volume is low relative to this volume. That's why you've got higher prices. Now, they're not there to help you, and that's why they whipsaw the market like this. Goes up. It's meeting quite a bit of supply here, but that could easily be pushing up through this high here. And the reason why that is because you'll always have traders locked in these old highs across there. And then what the professional money will do, if they're bullish, they will absorb selling. See, if you get locked in a high like this and you see this fall like this, right, and you don't realize that's bullish, okay, you think, oh, I must get out of this. When the price goes up, now professional money know that's what you're thinking, and that's why widespread up, they try to gap it up, look, and the high volume could easily be them absorbing any selling from this level. That's bullish. And then if they test it, which it looks if they have here, that's telling you, yes, they've absorbed the selling, right? So you expect higher prices. So you actually expect lumber to go up.
Okay, thanks, Tom. That's about it, folks. There's just one thing I want to read out, actually, from someone in the room, Eleni. Everyone have a pleasant weekend for all traders who follow the rules. It just reminded me, thank you for that, just reminded me of the, Tom sometimes says, wait for your bus to arrive. In other words, if you get on the wrong bus, then you'll be disappointed. Or as Eleni says, if you follow the rules, you might have a pleasant weekend or a pleasant week. So, Tom, could you just, as a final few words, talk about getting on the bus rather than just jumping in?
Well, because the market is so devious and cunning, one of the ways it fools you is how long it takes. Human beings, you see, you sit in front of your computer there and you're impatient. You say, oh, God, I must get in and buy before I miss everything, right? And what you tend to do, because you're in almost a panic situation, wanting to get in and buy, right? You jump in the market at the wrong time. And I describe that as being in a bus station, you know. And if you want to get to a particular area, right, you must get on the right bus. You don't just jump on any bus. You jump on the bus that has your number on it. And you have to know the principle of testing at that level where the first stopping volume appeared, which we clearly see on this chart. Here. There's the stopping volume, look. And there's a test. But in the meantime, you've got to live through all this. And whatever happens, they're not going to help you. Matter of fact, they'll want to mislead you. So they're not going to give any news that's going to help you. And if it falls down here, then that'll be some bad news probably. So you have to, I mean, there's so many charts to pick from, to choose from. You don't have to rush in and get on the wrong bus. You just have to know this is what happens most of the time. Sometimes, well, it always tests, but sometimes it might test a sort of higher level up here, which it does, or test even earlier, like we saw previously on that chart we looked at. Right? So you have to understand the principle, and then you have to wait for that to appear. And then when it appears, if you can trade on that, then you're up with the boys, the professionals, because that's what they do. That's how they read the markets. But then your skill as a trader kicks in. If it was easy, everybody would be doing it. But so you've got all sorts of obstacles you have to overcome. And one of them is your own, you're an obstacle. You know, you're impatient, oh, I must get in, look, I've got stopping volume in the background, and so on and so on. But there are so many charts, so many vehicles to look at, that make sure you get on the right bus. Understand the principle. Anyway, I'll say thank you very, very much for listening. And do have a nice, we have a holiday here, I suppose you do wherever you are. and the weather's lovely. And I had a friend ring up from California only yesterday and said, oh, it's 85 degrees here. So it's pretty hot some places.
Okay, thank you, Tom. And I'll say goodbye to Rita.
Yep, someone just saying recording. Is that going to be up? Yes, Peter says to Colin, that hopefully the recording will be up. It's so long as there's not a technical problem. Okay, we'll see you, well, newsletter on Sunday, and we'll see you next Friday. Thank you. Bye-bye.
Welcome to GoToWebinar, Web Events Made Easy.